Hi, Business Economics and Financial Accounting. BIFA is the title of the paper. This paper is meant for all engineering students. This is also studied by MBA students and it is there at the intermediate level also. The major difference that you find is engineering students who have technical knowledge either in mechanical or in civil or in information technology, computer science engineering, or you have chemical engineering, take any type of engineering. Most of the technical knowledge that you gain in engineering course will have to be supplemented with the organization where you are going to work. So a student who joins in any organization should have basic idea about the basic principles on which the business firm runs and basic knowledge in terms of production, costs, profits, objectives of the firm, and then what is the market in which they have to operate, that is market structures. So these three units are explained in 3 units in your curriculum. The first unit speaks about the introductory part, including business structures, business objectives, national uh, ecology, what is the national situation that is available in the national income, population, those aspects. Then we will look to the micro aspects like demand function in second unit. And in the third unit, we look to the production function, cost function, and supply function. In the fourth unit, we look to the market structures like perfect market, monopoly, etc. Then we will learn another 2 units, financial accounting, fundamentals of accounting. Because the accounting will give you a responsibility or answerability to the students. So this is the overall picture I would like to give about the paper that we are going to have. This is very interesting paper. In fact, you will love to learn this because this gives you a broad picture about the business and economics. Now, as a starting point, let us learn about the business structures. What do you mean by structure? As all of you are engineering students, you know what is a structure. It tells you the form, it tells you the components, it tells you the system, it tells you the interrelationship among the different components of the business systems. That's what we are going to learn. So if you take this, the kinds of business, always we advise do what you love, the money will follow. See, purpose of the business is not making money. Please make it very clear. Purpose of the business is to create a customer. If an engineer is able to bring out a new app that serves the needs of the customer is created. Once a customer is created, he is ready to buy your product. When you charge a price to him, the price includes your expenses and profit, and you will be able to make money out of it. So, money will follow. That is what it is shown there. When you do a business, the result is money. But the purpose of business is not money, as the Peter Drucker says. Purpose of the business is to create customers. So when we want to create customers, who should do this? Owners and managers should do it. So what is the ownership structure? We will learn first. Then what is the management structure? We will learn next. These two are there in this particular topic which I am going to cover. Ownership is, you have four types of ownerships. One is sole proprietorship. Second is partnership. Third is LLC, that is large corporation. Then corporations, not for profits, and corporations. You may have cooperative organizations, etc., but I am broadly covering these four. So when you take this sole proprietorship, for example, the sole, as the name suggests, one owner. Suppose you develop app by yourself. You are the only person available in the ownership. You fund the business, you bring money either by loan or by your own money or your parent will give you, and you have purchased one computer and then started app, and that app will facilitate many customers to join there and then pay you for using your app. So you get the revenue generation is done, and entire revenue comes to you because you are the only owner, and entire expenditure you have to bear because you are the only owner. So sole proprietorships are easy to form by a single person. The legal existence of proprietorship is extension of the proprietor only. So legally, since no other person is there, you are there to bear the expenditure, and you are the legal owner of the firm, and legal existence comes with you. It may have any number of employees. You may recruit 100 employees, but you are the only owner. Unlimited liability. If any liability you incur in the business, you should only bear. No other person will come to rescue in sole proprietorship. And you have to pay tax on the profits that you earn by yourself. So this is called the sole proprietorship. A kiosk she is maintaining with crockery. Then you have partnerships. The moment we say partner, there should be minimum two persons. Two or more than two. How many? It can go up to 20 in normal business, 10 in case of banking business. So business owned by at least two people may have many number of employees, must be in writing more than 1 year. That means if you are doing only for 1 year, it is not called partnership, it is only a joint venture. That is a different form. But in a partnership, you have normally for more than 1 year. No double taxation. Partnership firm will not pay tax, but partners individually pay tax. So when you take the share from the business firm, that share will go to individuals, and individuals have to file income tax return individually. Hence, no double taxation here. Unlimited liability for all partners. Every partner is liable for the loans made by others. So this is the ownership structure in case of partnership. And in partnership, each partner is liable for the actions of the other. We call it as mutual agency. Every partner is an agent and also principal. He is the principal for others who do actions. For their actions, he is responsible. Similarly, others are responsible for you. When you are responsible, you are the agent. That's called mutual agency. So, unlimited liability. Each one is individually and personally responsible for all the liabilities that you make. The creditors' claim attach first to partnership assets. If they are insufficient, they can attach personal assets of the individuals, also partners. Therefore, if you take a liability, it is unlimited liability in partnership. And the co-owners, you are all co-owners of the partnership. Therefore, in case the um, assets are there, if you are closing the partnership firm, After paying the liabilities, if there is any surplus amount, that surplus assets are owned by all partners. They are called co-owners. So co-ownership of the assets will be there. This claim does not attach specific assets. You can't say this furniture is mine or the computer is mine, but overall all assets are owned by all partners together. So they must distribute in their capital form. Then share income or loss. Suppose you get a profit or loss. If there is a profit, all partners will share. If there is a loss, all partners will incur. However, at agreed ratio, as per the agreement, sometimes somebody may bring more capital, therefore he may ask for more share. Sometimes people may bring equal capital, but one person is totally taking responsibility and doing the business. So so as per the agreement, you have to pay. If there is no agreement, you must share it equally. That's what we say. In the absence of agreement, equally. Then you have limited partnership also, which is called LP. In a limited partnership, one or more partners have unlimited liability and other partners are having limited liabilities. Normally this happens, when somebody wants to be a sleeping partner. When you say sleeping partner, it does not mean he will sleep in the office, but he doesn't take active role in the partnership firm. He will only enjoy the results, profits. If it incurs losses, he also has to bear. In such cases, he may have in agreement that his liability may be limited to the capital that he has invested. He may not ask more over and above that. So this is also possible. Then limited liability partnership is different from limited partnership. Limited liability, LLP, limited liability partnership have limited liability. There are no general partners. It is designed to protect innocent partners from malpractice or negligence, claiming resulting from the acts of another partner. These professional partnerships vary in size from a medical lawyer partnership of 3 or 4 by directors to 150 partners. So this happens when in a professional organization, the professionals will have special liability and non-professionals who are also partners may have limited partnership liability. This is also possible in professional organizations. Now we come to the LLC organization. What do you mean by LLC organization? Hybrid for corporations. One or more owners. Owners are called members. No double taxation, less paperwork and regulations, more freedom. This is there mostly in USA, LLC, where it is a extended partnership. It's not a partnership, but joint stock company, almost like a private limited company in India. Then we come to the limited liability companies. This is hybrid business organization with certain features like corporation and others, like a limited partnership is the limited liability company. A limited liability company usually has a limited life. The owners are called members, have limited liability like owners of a corporation. Whereas limited partners do not actively participate in the management of the company. The members of a limited liability company can assume an active management role. See, this is a starting point for corporations, wherein ownership is divided from the management. So, Reliance, for example, the Reliance Mukesh Ambani may be having the very minor shares, hardly 10%, 12%, but remaining 85% are scattered by millions of people. They are not owners and they don't manage, but they will participate only in the dividend. So legally they are owners, but management point of view, they don't take any responsibility. So this is limited liability you have. Then you have, of course, relatively which one is better and which one is there. You can look into it. But more than that, we can say this corporation, the word corporation is used in America for the joint stock company. So joint stock company, when you take up, an entity is created by a state stature. It is an entity. That means business firm is different, owner is different. So Reliance Company Limited is different, Ambani is different. Adani Corporation Limited is different, Gautam Adani is different. So the owners are different and firm is different. So that is called entity, legal entity you create. It is an artificial person created by law. So by law you create it, it exists separately from the owners. It may have one or more owners. You may have one Solomon company, one person only. Otherwise, owners are called shareholders or stockholders. So when we take up the stockholders or shareholders, ownership evidenced by stock certificate. If you have a stock certificate, you are the owner of the firm. And it is created by law, as I have mentioned just now. It is created by law. So it is separate entity. We can call it as publicly held and privately. What do you mean by it? Classification by ownership distinguishes by policy held and privately held corporation. Publicly held and privately held corporation. Two types are there. Publicly held corporations may have thousands of shareholders. Stock is regularly traded in national stock market. That means you can buy the shares in the national stock market anytime. If you are going for a Bombay Stock Exchange, if you go, that is called secondary market. In the secondary market, every day your shares are quoted and you can buy or sell any day, anytime. This is called public limited company. Most of the large US corporations held like this: IBM, Google, General Electric. You can take any number of examples like Reliance Petrol Limited, Reliance Telecom Limited. You can take any example. Privately held corporation means very few stockholders will be there and stock transfer cannot be made without the permission of the company. So in this case, number will be limited. There will not be more than 50 shareholders, and mostly it is governed by its internal rules, that is articles of association. And it is almost like a partnership, only difference is it is a limited liability. So each member can transfer his shares only among them, not to the outsiders without the knowledge. So separate legal existence is there in this particular form also. But the transferability of shares is restricted to members. Limited liability of stockholders. Here also you have limited stockholders, shareholders. Then transfer of ownership rights. Shares of capital stock give ownership in a corporation. These shares are transferable units. Shareholders may dispose of part of their interest of the organization by selling in the market. This is publicly held. In private limited company also you can transfer the shares, but there are some restrictions which are passed according to the articles of association. There will be a perpetuality. That's called perpetuality, means continuity of the business firm. A business firm once established, started by 7 members. Let us say one or two persons died. The firm will not get closed. His legal representatives will become automatically the members in the firm, and it continues. If anybody leaves, he will sell his shares to some others. So he will be replaced by another person. Men may come and men may go, but firms will exist. That is called perpetuality. And corporation management also, Ford company, for example, stockholders legally own it. They have a CEO, Chief Executive Officer. So normally you will have a structure like this. Top level, you have stockholders. Among the stockholders, they will elect one person as a chairman, and there will be a board of directors. Few of the stockholders will become members in the board of directors. They will do the governance. We call them as governance. And they will appoint one CEO among them, either among them mostly, or they can appoint outsiders also. In America, they call them as president. In India, we call them as CEO or managing director also. That CEO onwards, administration starts. Administration is different, governance is different. Governance decides about the broad policy of the organization, whereas day to day activities are run only by one CEO, and he will take decisions. He will be supported by Vice President Marketing, Vice President Finance, Vice President Operations, Vice President Human Resources, General Counsel, and Secretary. These names can be different. Instead of Vice President, somebody may call it as a manager. Manager, marketing manager, general manager. You can have it. Then you have a treasurer and controller. So you have a farming corporation, and ultimately you will have the benefits of running the organization. So the structure is this is the administrative structure, and earlier I have discussed the ownership structure. This completes the business structure talk. Thank you.